So today we're going to talk about when to exit a property. There's a multiple different exits you can do. When's the right time to do it? What are some things you should do going into an exit? What are some things you shouldn't do? The first thing I'm going to talk about is something that I think a lot of new investors don't know much about or don't really factor in when you go to buy a property. And that's something called your annualized total return. So it's very easy to look at just the return you get per year. So if you put $100,000 in, you get 10,000 back, that's 10%. And in 5 years, if you're still getting that $10,000, you're still getting 10%. But the reality is if that equity has grown and you have $200,000 in there, now your actual return is only 5% on the money that you have there. So there's kind of a sweet spot where you'll have lots of equity built up, you'll be getting a nice return, but if you could take all that equity out and reinvest it, you'd be getting even more. So for me, I like the 8 to 10 year period. We give it a little bit of a window. I have a chart here that'll show you just a building we had underwrote a while ago. And it kind of shows like annualized total return if we sold year 1 was 16%, year 2 is 21%, year 5 is 20, and then by year 10 it's 16. And then it tapers off after that. By year 30 it's actually only 9%. The reason being because your equity went from at the beginning 2.4 million and by year 5 it's around 4 million, just over, and year 10 you have almost $7 million of equity in there. This was ran on just a 2% growth per year. You can kind of see how, like, if you could pull that $6 million out at year 10 and have it reinvested somewhere else where you were getting a 10% return on the full amount, you'd be getting a lot more than what you would if you left that money until the end of the investment. So for me, I don't like to do quick things. I don't like 2 or 5 years. I think it makes sense to do it longer because you just have more mortgage pay down, more appreciation. You're not trying to time the market. But that's something when you go into an investment you should look at. When's the dollar amount that we want to pull out? So maybe that's 5 years. Maybe it's you just say, hey, when my equity doubles, I want to refinance some money out and go buy another property. And that's a strategy you can kind of come up with at the beginning going into it, because you won't know exactly how much equity you're going to build up. But just endlessly leaving it in there doesn't make a lot of sense. And for a lot of people, it also doesn't make a lot of sense to sell the property. So refinancing money out is the best way that I think you can kind of play both fields. You can still have a good property, cash flowing great, because when you pull that equity out, this property is going to cash flow less because you're going to have a higher loan to value again. But you'll be able to take that money and reinvest it into something else. And kind of similar, if you have investors investing alongside of you, not a lot of people like the idea of just having their money in there endlessly. Like, you have a time period where, like, hey, you'll have the ability to get your money out in this window. For us, that's 8 to 10 years. That's not saying we're going to sell everything, but everyone will have the opportunity to take their money out, and then we'll most likely just refinance the properties. We'll still have these great properties that we want to hold for another 20 years, and we'll be able to go out and buy new stuff. They can reinvest in the new stuff if they want. So that'd be my first thing. Look at the total annualized return. I think that's missed by a lot of people. So I think the thing to look at, most people focus very heavily on the cash on cash. And if you look at the example on the screen, the cash on cash goes up every year, right? So it'll be a chart that just continues to go up because you're hopefully getting rents up, getting more cash, but the total annualized return will actually go down over time. So if we just pick a year, year 15, we started out, we were cash flowing 239. Now we're cash flowing 443. So that's great. But our equity is $9 million. So if you were to take that $9 million and put it somewhere else at 10% return, you're getting $900,000. So there just becomes a time where the money needs to, I think it should be pulled out and kind of recycled, reused somewhere else. And you can still be, invested in 2 different things, and the return will actually get better. So for me, that sweet spot is in that 8 to 10 years. I think that's kind of when you can maximize it. You pay down a lot of mortgage. You know that over enough time, buildings are going to appreciate, but you don't want to have it sit there endlessly and kind of go stale, because the total annualized return will go down over time. So the next thing I want to talk about is what to do with the actual building going into a sale. And this depends a little bit too on what your model is. But a lot of people starting out, you're going to buy something that needs some type of value add, and that's kind of going to be the model because that's what is going to be available at the start with the amount of equity people have getting into smaller, usually older buildings. I always tell people, don't go and renovate the entire thing and stabilize the building. If you want to refinance and keep that building forever, that's a good model to do. But if you want to fix it up and your idea is to sell it, maybe sell your smaller assets, get into bigger ones, leave some meat on the bone for the next guy. So if you have a 10-unit property, maybe do 7 of the units, be able to show, hey, we took rents from $1,000 to $1,500. And if you buy this property from us, you still have 30% of the units that you can go in, get rents up. Because a lot of people who are going to be buying those smaller properties are the same type of person as you who want some value add there. But not a ton of people in the smaller multifamily space are looking for fully stabilized buildings that with no value add, right? Because the margin isn't great on them. There's not a lot of cash flow. So they're wanting to say, hey, we can buy this, and then they want to see some upside. Like, we can do these next 3 units. We can get the rents up to $1,500. Now we have some upside, for them to go sell or them to hold it or to refinance. I think leaving some for the next guy on smaller multifamily because of who the people that are buying those are is really crucial. I don't think there's a huge market for fully stabilized small properties. And then the last piece of it is how to actually market, where to find someone to buy your property. I would always go with a realtor and find the guy in your market who specializes in that type of building. So for my instance, I did have 2 small 8 units that we'd started with. I didn't use the same guy that I'm buying 100-unit properties from for my broker to sell the 8 units because he's connected to all the institutional people, the bigger buyers. And there's another company that specializes. They sell a ton of 8 to 20-unit properties. So find who that person is. They're going to have a network of people. I wouldn't go, a lot of new people you're trying to save money everywhere you can, and maybe you want to just try to list it on your own. But there's going to be so many tire kickers. You're not going to really know who the serious people are, which a broker will have a little better understanding. They'll be able to give you some guidance and say, hey, look, we know this person. They've done 10 deals in the market, or we have no idea who this person is. Say they have the money, but we have no clue. So get the right broker, find who they are. It's very easy to do in a market. You can find, there's only going to be 1 or 2 people in any city that specialize in smaller stuff. There might be some more, but they'll be the best 2. And they'll be able to get you probably a higher price and have the story of the building, right? Even when you tell them, it's like, hey, we've done 70% of the units. There's 30% upside. We think it's a great value add for a new investor. Here's the things we've done. The roof might need some work. And you just be open, be honest about what needs to be done to the building, what doesn't. People usually like the upside. On smaller properties, you're going to get a lot more haggling, I find, than on the bigger properties, because the people are going to nitpick and try to save on every little thing. But find the best broker in the market, leave some meat on the bone. That goes a long way.